With us this morning here in person for a pleasant change is one of the most cautious voices among economists on Wall Street. Brian Wesbury, he is chief economist at First Trust Advisors. He predicts a relatively swift recovery from the current crisis, but warns of inflation that comes with the Fed action that achieves it. So, Brian, we're glad to have you, as we say,
Good to be
right
with
here
you.
in the studio, not remote from Chicago, from rainy Chicago, same as rainy New York.
Yeah, rainy everywhere.
So is it fair to say you're almost worried about a faster recovery from the recession?
Well, I don't think inflation really comes from too much growth. I think it comes from too much money. And really why we are recovering, in a sense, and in a V-shaped pattern is because the Fed has put so much money into the economy. We're floating on a sea of liquidity, if you will. And it's kind of like 1975, 76. So right in the midst of the horrible 1970s, we had this boom in the economy for 2 years, a boom in the stock market, but it eventually led to lots of inflation down the road.
On a scale of 1 to 10, how confident are you that the Fed can stop up the extra liquidity?
Yeah, about a 2.
Really that low?
Yeah, remember, it's like taking drugs. I mean, if you get hooked on morphine, not that I've ever been, I saw it on TV once.
I'm addicted to caffeine, so
yes, there you go. If you try to come off of that, it's painful. I mean, and that's kind of what I think about monetary policy. And that's why, for example, in the 70s, we got in so much trouble, because every time we tried to raise rates and roll back the money, the yelling started. You know, unemployment goes up, the economy goes into recession.
But I mean, there was also an energy crisis. I mean, there were other things happening.
Oh,
right?
sure. Well, we had $145 oil last year. No, we don't, but we could. Again, so nobody knows what the future.
Brian? I mean, most people that we're speaking with, at least about the price of oil, are saying, you know, $55 a barrel is very likely, more than 170.
See, the 70s, the reason the 70s were so bad, the reason oil went up so much was because the Fed was so easy. And that's why it went up last year. That's why it's still 3.5 times higher today than it was 5 years ago. And it's because the Fed's so easy. That's, I guess, the point I'm trying to make here.
So if you were in Ben Bernanke's shoes, would you start raising rates now?
I would. You know, and I know that's hard. It's politically not a good thing to do. But, you know, if you go back to the early 1980s, we had 3,000 banks fail in the 80s and 90s. It was a horrible banking crisis. Bad loans to farmers, bad loans to oil producers, bad loans to Latin America. And yet Paul Volcker jacked up interest rates very high, and we still did okay. And so the point is that inflation, like we had in the 70s, is very damaging for the economy. Tighter money, like we had in the 80s, actually worked out very good, even though there was a banking crisis taking place. I would argue that today, higher interest rates and good, solid, what I would call a strong dollar monetary policy is really the best thing we could do.
But as you say, it's politically unpalatable.
Because people don't understand, I think, history and monetary policy and the damage that it can do. You know, I think monetary policy got us into this problem. When you had 1% interest rates back in 2003 and 2004, people were fooled, in a sense, into believing that money was so cheap. That's why they bought a 2,800 square foot house instead of a 1,600 square foot house. That's why they bought granite countertops instead of Formica, because they thought money was cheap. And they were fooled into believing that because the Fed held interest rates too low.
What about consumers' restricted spending power right now, which in theory keeps some prices low? In other words, there shouldn't be an inflation threat if people aren't getting raises, if productivity is going higher, which basically means the average worker just getting squeezed but doesn't have any more money in his or her pocket. I mean, that has stayed, those costs have stayed relatively low.
They have, and that what you've articulated there is what I would call the Phillips curve argument, this idea that when unemployment goes up and growth slows down, inflation goes down. You know, what's interesting is that all of the models that the Federal Reserve uses would have predicted that core inflation, when we strip out food and energy, would be way lower than it is today. It's actually held up and, in fact, accelerated in the last couple of months. I'm sure that's bothersome to the Fed. It's a red flag to me, and I'm sure it's very bothersome to the Fed because they're not getting the drop in inflation that they expected.
Why do you think Janet Yellen then said yesterday that rates are going to stay low for a very, very long time?
Because I think that's the political environment that we're in. If they tried to raise interest rates, what would happen is there would be, for lack of a better term, a lot of screaming and yelling. People would get worried. And you've articulated it very well. How can you raise rates when unemployment is so high? Go back
the voice
and
of the people.
Yeah, go look at the early 1980s. Paul Volcker jacked up interest rates to 20% when unemployment was almost 11%. And the 80s turned out to be a great decade.
All right, Brian, always good to have you.
Yeah, it's
we'll get
great
you
to be with you.
frequent flyer miles. Hopefully get you back to New York more often. Chief Economist of First Trust Advisors.